In New York City, I'm Julie Hyman, that is Josh Lipton, and this is Yahoo Finance Live. Here's what we're watching this afternoon. Stocks taking a little break from their record run. The Dow and the S&P 500 pulling back a bit after hitting new highs earlier in the session. Investors waiting on a slew of economic data this week, especially, of course, the PCE report. That could provide fresh insight into the Fed's path toward cutting interest rates. What you need to be watching for in that data is straight ahead.
Plus, the government suing to block another merger, this time in the grocery space. The Federal Trade Commission arguing a tie-up between Albertsons and Kroger would lead to higher prices for consumers. We have the latest developments ahead.
And we are tracking the big moves in crypto as well. Bitcoin hitting a fresh two-year high above 54,000. Ethereum also catching a bid as interest in a potential spot Ethereum ETF picks up steam. And it's not just the currencies themselves. Coinbase also hitting a multi-year high. We're tracking all of the action. Let's get you up to speed on the market action right now as we have this kind of little breather that we're seeing the market take today. Although, I should mention, Nvidia is not taking a breather. The stock is still up today. The Nasdaq, though, kind of going sideways here, not even up 0.1%, while the S&P 500 pulls back about 0.25%, and the Dow little changed as well, down just over 20 points. If you look at the groups on the move in the S&P 500 today, utilities are actually down the most in percentage terms. We do have a little bit of an uptick in yields today. That could be putting pressure on them. Communication services is also lower, being dragged down by Alphabet, which we'll talk about when we get to our trending tickers. Energy stocks and infotech, though, are up today.
All right, Julie. You know, let's do, Monday. Let's do things a little differently.
Let's
How about
do
that?
it.
Let's start with the economy. How about that? Would that
That's
be
a good place to start.
Okay. We can expect a soft landing, 2% GDP growth and cooling inflation. That is according to a new survey by the National Association of Business Economics, who say 2024 will be a bumper year for the economy. That theory will, of course, be put to the test this week with the latest PCE data out Thursday, as well as a slew of other economic data. And joining us now is Greg Daco, chief economist at EY, to give us his very latest. Greg, great to see you.
Great to see you too.
Maybe we'll start there, Greg. Just listen, we said the soft landing camp. That seems to be consensus. Is that where you are at for 2024?
That's, I think, where we are. I think we are in a situation where we've seen the economy cool a little bit, but not dramatically so. But importantly, that cool down has brought inflation lower. So the rebound on the supply side and easing consumer demand has brought inflation a little bit closer to the Fed's 2% target. That's really what we're after. After all, we're not aiming for a recession. We're aiming, or the Fed is aiming, for an environment where inflation's closer to that 2% target and we're on a sustainable economic trajectory.
So you say inflation's coming back down to target. So you don't seem concerned about that CPI print that we recently got that set everybody sort of aflutter ahead of PCE this week. Was that CPI report head fake? Was it sort of a misreading of the data? What do you think?
I think the January data was extremely noisy. It wasn't just inflation. Inflation was hotter than expected, both CPI and PPI, but we know that there was a bit of a January reset effect. We also know there was some seasonality in there, and we also know that some of the data was affected by some of the weather patterns. So I would take a lot of the January data and really put it aside, whether it's the jobs report that was very strong or the retail sales that were very weak and home sales activity also on the softer side. Weather was a big factor, and some of the January data is quite noisy. So I would take a step back from that data. We are still in an environment where we're seeing inflation move towards the Fed's target. The numbers on the PCE front later this week will indicate that, yes, on a month-to-month basis, there is a little bit more of that stickiness, but on a year-over-year basis, which is what the Fed is paying attention to, we are seeing that movement towards the 2% target. So we're still moving in the right direction. The Fed will be a little bit more cautious than we are because it has to balance that risk of inflation rebounding, and they don't want to essentially lose that battle against inflation.
So, Greg, so we're moving in the right direction, you say. So what does the trajectory of inflation look like to you over 2024? Because Greg, some of your colleagues, other economists said, getting back to 2%, they argue, and staying there, they still argue might be kind of tougher than some people expect. But what do you think?
I don't think the last mile is the most difficult. There's nothing to prove that the last mile, getting from 3% to 2% inflation, is the most difficult. We are in an environment where you still have disinflation in the pipeline on the housing front. You have an environment where consumers are pushing back against higher prices, higher costs. That's disinflationary. We have an environment where productivity is very strong in the US. That's the outperformance that we're seeing in the US relative to its peers. That's also disinflationary. Wage growth is coming down. Wage growth compression is very much part of the story when we talk to a lot of our clients. So overall, if you look at all the dynamics that are happening in the US economy, they're all pointing towards a disinflationary environment. I think by the end of the year, we'll be very close to that 2% target.
It feels, it's so interesting looking at where we are now versus where we were last year at this time, right? And that NABE survey is just the latest piece of sentiment data from professionals that shows that they're not going to make the same mistake they made last year. But the question is, do you run the risk of then the opposite mistake, that you're over optimistic instead of being over pessimistic?
I'm always a little fearful when the consensus shifts uniformly in one direction. We've been saying for a while now that this recovery has legs. We're still actually a little bit higher than the consensus forecast from NABE. We're at 2.2% for growth this year, which is quite strong. But we're noting that there is a little bit of a slowdown in terms of economic activity. One key factor to monitor very closely is what happens to the labor market. If we start to see less job growth, less diffuse job growth across sectors, fewer hours worked, which are some of the signals we've started to see, that could portend to a more significant economic slowdown because that feeds directly into income, and income is the key support to consumer spending activity. So to me, that's the most important element to watch. On the upside, very encouraged by the productivity data. I know productivity is hard to measure, very hard to capture in real time, but we are seeing some solid signs in terms of that pro-cyclical productivity momentum, which is very encouraging.
Also, Greg, I want to get your take on the housing sector too, because we did get this morning some new home sales. They turned higher in January. How are you thinking about that sector in 2024? Especially, Greg, you looked at 30-year fixed, we're above 7% again.
It's the most interest rate sensitive sector, right? It's the typical sector that reacts first to the type of rapid increases in interest rates that we saw from the Fed. We saw home sales plunge in the wake of that significant tightening of monetary policy. But importantly, that's a sector that's undersupplied. So the construction side has not been as negatively impacted. And the other thing to look at very closely is the fact that we have much less leverage in the housing sector than we had back in 2007, 2008, 2009. We have a deleveraged housing sector, which is very positive because a lot of the momentum is not driven by debt, but rather by solid income growth and solid wealth growth. That's a positive. That's why we haven't seen the type of broad-based correction that we saw during the financial crisis this time around.
Greg, while we have you, I also want to ask you about the political risks to the economy, right? Which I feel like are not getting as much of attention. Again, we have a potential government shutdown. The market doesn't seem to be terribly concerned. I mean, and maybe they've been proven right because we keep getting, 11th hour agreements or extensions. Is that what's going to happen again? And then once you answer that, I guess we can get to the other sort of looming potential economic issue later this year.
Yes, there are a number of big elements that will unfold on the political front. You're right that we have seen these instances of a feared government shutdown, a debt ceiling debacle again and again and again. And I think there is a little bit of fatigue in terms of how markets are pricing these developments. We're not sure whether there will be a last-minute agreement this time around, but I think the odds are fairly high that there will be some form of agreement, perhaps even another short-term continuing resolution to extend funding a little bit further and give Congress a little bit more time to essentially come up with the 12 appropriation bills that they need to pass a full-year budget.
I'm interested, Greg, just as an economist, though, do you think we talk enough in this country about our fiscal challenges? Because it's interesting, politically speaking, I don't hear Biden or Trump, frankly, talking that much about it.
Well, I think you have to distinguish the amount of debt that we have and the deficits that we're running, which are quite large. And if you look at the CBO, the Congressional Budget Office latest forecast, they're expecting budget deficits over the next decade to go from $1.5 trillion to $2.5 trillion over the next 10 years. But what's very important, and perhaps more important than the amount of deficits, is the cost of that debt. The interest payments are expected to represent about 3/4 of the increase in the deficits over the course of the next decade. That, to me, is the most important part, how much we're paying for interest, which is not being driven towards demand, towards support programs for children, for low-income families, et cetera. That's where I think the key issue is really that we have to focus on.
Although, again, to Josh's point, nobody seems to be interested in decreasing that.
We're focused on it here.
We're
at this
talking
table.
about it,
yes, with Greg.
Are there any other, most of the discussions we've been having about the presidential election have centered around market perception and what's going to happen in the markets. What about on the economic side? I mean, I think perhaps sometimes it's overstated the effect that a single president can have on the economy. But are there certain things that you are watching that could have an effect?
Certainly. I think it works both ways, right? The economy influences elections, and we know that cost fatigue is likely to be a big factor as we approach election time. But on the flip side as well, we know from the prior administration that there are a number of executive actions that can be taken, including on the trade front, that can have a significant impact on business activity. We know that the trade wars, for instance, had a significant impact on economic activity, but not just because imports cost more, because there was a lot of uncertainty as to the future of trade relations between economies. And the uncertainty is something that a lot of businesses dislike. They'd rather know that there is going to be a tax increase or tariff imposed with certainty and be able to plan for it than not know what's going to happen.
Interesting. Greg, thank you so much for helping us kick off the show today.
Thank you.
We just covered a lot of ground in a short amount of time. Thank you, Greg. Appreciate it. Let's check in on a few trending stocks from the Yahoo Finance ticker page right now. Shares of Google parent company Alphabet, they are down today. That's after one analyst shared some concerns over the tech giant. Melius analyst Ben Ritzis highlighting that Alphabet's missteps in AI may fuel the perception that Google is an unreliable source for artificial intelligence. The analyst reiterated his hold rating on that company. So this was interesting, an interesting note, Julie, in that yes, he did reiterate the hold. Target is 164, but this was a pretty tough note. And bottom line, yes, he says it has a moat in search, but this space is about to be disrupted, he says other Mag 7 companies, frankly, are outflanking them in margin optimization, in growth, in recurring revenues. Talks about how the company last week released that AI image generator called Text Image AI, which was frankly a debacle, made headlines for all the wrong reasons, and says if this fuels the perception that in fact the company is an unreliable source for AI, that is understandably bad for business.
Yeah, his note on this is called cheap for a reason.
Yeah.
And he has this hold rating on this stock. It's also interesting because he suggests alternatives to Google search. He encourages people to play with Perplexity AI's solution. He says in the note that is a private company, Perplexity AI here. And he also talks about OpenAI running a new search product. Perplexity does run on the OpenAI platform. I do, you have to wonder, habit is a powerful force. And so you do wonder, it seems like it would take a lot for people to stop using Google. But, this is an interesting question about the sort of reliability, because Google has worked in part because of its reliability in search.
Yeah, I think it speaks to kind of this broader concern you're hearing with Alphabet, though, among kind of analysts, investors, that, then they're kind of positioned AI and they have the data. They've got some of the smartest engineers on the planet. They certainly have a mountain of cash, but this perception that they're not moving as fast as maybe some of their peers.
Right. It's an interesting argument. So we'll see what happens there. As I said, it's really dragging down communication services. But let's talk about another big tech stock, Micron, because those shares are higher today. The chipmaker announcing it's begun volume production of its high bandwidth memory 3E solution. What is that? Well, it's going to be part of Nvidia's core GPU, and Micron says these are going to begin shipping in the second quarter of this year. Now, Micron is a memory chip maker, which traditionally is seen as more of a commodity product, and I think there were some questions among investors about what role the memory chip makers were going to play. So this is sort of a concrete example of what Micron is going to be doing here. SK Hynix, which is its major competitor in this area, has been something that investors have been watching too. So obviously investors like the news that Micron's participating here.
I feel like every show we need to talk about Nvidia. So this is the way we're doing it today. Micron saying, by the way, more is going to be revealed about its product pipeline at Nvidia's GTC Developer Conference next month, which has kind of become the big AI show, frankly. And remember on their last earnings call in December, Julie, they did talk about how Gen AI would drive what they called a multi-year growth phase for the company, would lead to a record revenue for the memory kind of industry market in 2025. So they have been sounding confident, and investors have been feeling confident. Look at that stock, it's up nearly 60% here now in the past 12 months.
Yes, indeed. It's definitely a big move.
Big move. Finally here, The Federal Trade Commission is suing to block Kroger's $24.6 billion acquisition of Albertsons. Kroger responded saying that blocking of the deal will actually harm the very people the FTC purports to serve, America's consumers and workers. So the FTC, and my understanding is, Julie, it's actually also 8 states, Washington, D.C., suing to block this acquisitions. They don't like it. They argue it's going to mean higher prices for groceries. It's going to mean lower wages for workers. So the combination of these two chains would lead to just a very concentrated market.
This has been going on for a while, first of all, we should mention. The two first agreed to team up in late 2022. It's a almost $25 billion acquisition. And at the time, you know, it was expected that there would be a challenge at some point, but it sort of dragged on and dragged on and dragged on. And now finally here in early 2024, we are getting this formal challenge from the FTC. The grocery stores are arguing that the FTC's view of the grocery industry is outdated. They bring up competitors like Amazon, like Walmart in the industry that they say, you know, it's not about just looking at traditional grocery stores. It's about sort of widening the aperture here of what constitutes a grocery store. At the same time, the two have already planned to sell off some of their holdings, and the FTC says, no, that's not enough.
They try to clearly placate them
Yeah.
with that, but that did not work. Just interesting, I mean, this is the broader story we talk so much about on the show, about how regulators just so much more aggressive now when it comes to deal making. JetBlue and Spirit, Microsoft, Activision, just a very different regulatory backdrop, regardless of the industry you're in.
It is, and that's, you know, if you look at how the stocks are reacting today, we're not seeing a huge reaction.
Expected.
In part, and this challenge in particular was expected, but to your point, the broader environment is also just seen that way right now. Well, we are just getting started here on Yahoo Finance Live. Coming up, Bitcoin jumping today, sitting above $54,000 for the first time in 2 years. We're going to be checking in on the latest crypto news throughout the show. Plus, another batch of earnings to kick off the week after the bell today. We'll be breaking down the latest numbers from Zoom, Workday, and more. And starting next week, our final hour of market coverage is getting a new look. We'll have you covered on everything you need to know to better fit your portfolio and dominate the market. Stay tuned. We've got more Yahoo Finance in a moment. It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Broader markets seeing muted action in today's trade, but the big move is in crypto. Let's get it over to Jared Blickery for more. Jared.
That's right, Josh. We got some milestones in the rear view mirror. Seems like only hours ago I was talking about Bitcoin 52,000. Now it's Bitcoin 54,500. And Ethereum really stealing the show today. It's only up 2% over the last 24 hours, but it has finally cleared 3,000, and that was kind of flirting with that number last week. Now it has decisively moved above it. And now what's in sight here? We got the record highs basically for Bitcoin and Ethereum. For Bitcoin, we're looking probably at 60,000. That's going to be one of the biggest resistance levels. And in Ethereum, probably in the low 4,000s here. There remains quite a bit of price memory, but we've seen Bitcoin and Ethereum slice through these previous highs before in prior cycles. And what do I mean by cycle? Well, we're coming up against another halvening in Bitcoin. That has always been a bullish catalyst. Just kind of brings to the forefront the time when I guess the imagination that there is a limited supply, total finite supply of Bitcoin, and the miners, they drop out in these halvenings. So that's going to come in a couple months. But with respect to Ethereum, let me just stick on that for a second, because there is a key upgrade coming March 12th, March 13th called Dencun, D-E-N-C-U-N, and this is going to upgrade the speed of the network, basically going to make it more compatible with some of the upstarts like Solana. And let me just show you a Solana chart. That has really exploded to the upside today. Here's a 5-year look, but over the last 3 months, largely trading sideways, but we do have a range expansion today. Doesn't mean a whole lot until we clear 125, but given the length of the consolidation here, I would expect that punch above to have some momentum with it. And then just thinking overall about Bitcoin, the behemoth here, I mentioned 60,000 as a price target level. Actually, the highs that are about just shy of 70,000, but I would say 60,000 is probably the last stand here. And we are rapidly approaching that point. You got to imagine, what are the potential negative catalysts? I don't see a lot. There could be another sell the news event with something, but we got Binance kind of behind us. We're still waiting for the sentencing for CZ, but a lot of those crypto obstacles that were mired cryptocurrency in that crypto winter, most of those have disappeared. And so it seems like bright skies ahead for the crypto land.
Put your shades on. Thanks so much, Jared. Appreciate it. Warren Buffett's Berkshire Hathaway trending today after the firm reported record earnings over the weekend, as well as releasing its latest 13F filing. The shares earlier touched a record. In his annual letter to shareholders, Buffett praised the 5 Japanese firms owned by Berkshire and noted raising his stake in the companies. According to FactSet, since announcing their investments in Mitsubishi, Itochu, Marubeni, Mitsui, and Sumitomo, the returns in yen of those five companies range from a low of 185% to a high of 402%. Our next guest today says that Berkshire's not alone in looking to Japan for some success. For more on an investing outlook, both international and in the U.S., here's Matt Miskin, John Hancock Investment Management co-CIO. Good to see you, Matt. I know you guys look at the U.S. primarily, but you look around the globe as well. And I just wanted to start there with what you were thinking with Japan, because it's not just those stocks that have been doing well. We've been seeing sort of unprecedented, or at least returns in Japan that we haven't seen for a long time.
Yeah, Julie, it's a good point. Japan's Nikkei looks like a crypto currency right now. It's just been going up this year, and it's one of the best performers, if not the best performer globally. The only things we would say as potential negatives, it is a consensus allocation. So when we talk to asset managers, broker dealers, research firms that we work with, that was the #1 consensus call of 2024. In terms of how Japanese stock market has done so well, it's a bit perplexing, frankly. The manufacturing PMI is actually decelerated. The economic data doesn't look great. In fact, they're in a recession right now. And the stock market's at all-time high. Welcome to 2024, right? And so you're seeing actually weaker economic growth, but what they're doing is they're devaluing the currency. They're going to do QE, or quantitative easing, yield curve control, forever, perhaps. Because if they didn't do it, if they didn't tighten policy at the end of last year, I don't know when they're going to be able to do it. So there is tailwinds in terms of easy policy, weakening currency, but growth is weak, and it's pretty consensus. We like it internationally. We still like the U.S. more.
And let's talk more about the U.S., Matt, and pick it up there. I'm interested, Matt, how investors have clearly tempered their expectations for rate cuts, Matt, when and how many. Yet despite that, the markets continue to move higher. How do you explain that dynamic, Matt?
I try to come up with an analogy on this one, and I think the Fed basically called for picture yourself late night at a bar. I haven't actually done this for about 20 years, so I'm going off memory, and it's a bit cloudy, but nonetheless, when the bartender says last call, that was the Fed last year. So when the Fed said, "Hey, we're going to do rate cuts, we're turning more dovish," that was in essence telling the markets, this is the last call for a risk-on rally. And then as we come into this year, the bar's been closed. The Fed has been pushing back. So we've gone from 6 rate cuts priced into 3, and it might go to 0. I mean, actually, Treasury yields are up today. And so the economy's strong. Inflation's coming down, but it's not that fast. Actually, we're getting a bit of a resurging inflation here. So the fact is that the party's still going, even though the bar is closed. Usually when the tap is closed, the party starts to clear out. It hasn't. And so we do think that's going to be a headwind for markets. Is if the Fed comes back hawkish and we don't get these cuts baked in, it's going to be tougher for stocks than after this great start to the year.
Yeah, I also am reaching into the memory banks for this analogy, Matt. But, what is going to be the sort of catalyst, the realization? When is that going to hit the market that, they got to go home?
Yeah, it's just Treasury yields probably moving higher from here. And, housing has started. You talked to Greg last segment, just an awesome economist and talking about how interest rate sensitive the housing market is. Well, housing data actually started to rebound to start this year. And if mortgage rates come back up because there's just so much risk taking and investors are pulling away from treasuries and going into, say, Bitcoin or something, that's going to cause treasury yields to rise. And then you've got this circular feedback loop where higher treasury yields weaken housing again. And then that causes a negative growth impulse to the market. So we're kind of still pulling off or drafting off of the decline in treasury yield mortgage rates, and now they're coming up again. So I think basically, to simplify, treasury yields need to go up until something breaks. And until then, this market is probably going to be a momentum-driven market. And that risk is one, though, that could very well come about over the course of this year.
And Matt, another theme I want to touch on with you real quickly. I'm just interested, Matt, are you getting questions at all from your clients about whether we're now in some type of Nvidia-led AI bubble? And if so, Matt, what are you telling clients?
Yes. And I love just answering the question simply instead of dancing around it. Yes, this is AI mania to some degree, and we like quality at a reasonable price. So we are in the stock market. We're overweight tech. We're overweight the U.S., but there's parts that are getting frothy, and there's parts that aren't as reasonable. But Nvidia last week did deliver. And I mean, what a quarter. You just can't even draw this stuff up in terms of the growth rate and what just came off. But now that's the comps. It's what have you done for me lately in corporate finance? And really what we're seeing is these numbers are amazing. So now what are you going to do? You got to grow on top of that. It's going to be tough to do. So we are looking at that is still, it's a part of the technology sector. We're going to take that, but we are diversifying and looking at other parts of the market that are cheaper, less momentum driven, and they could get a rotation eventually if Nvidia stops its unbelievable run.
Yeah, we asked these same questions last year when they first came out with that blockbuster forecast, right? How are they going to keep it going? They managed to keep it going thus far. I'm curious, though, if you can dig into a little bit more in more detail those other areas of the market that you're talking about that maybe we could see that rotation into. Where are those?
Yeah, high quality industrials in the Midwest are cheap. They're seeing a lot of fiscal spending from the CHIPS Act, the Inflation Reduction Act. These companies have high ROE. They were up 30% last year, mid-cap industrials, but they're still trading cheap. So they were the only thing we found that had that kind of momentum to it, but also the fundamental support and not that expensive. So that's one place we take a look. And then high quality bonds. I know, Julie, we've been talking about these and we were early to it. But these yields, again, if I could get 6% on a single A corporate bond on a pretty low volatility basis, that over the next 10 years could look pretty attractive versus some of the other parts of the markets here. So we are still looking at that as an opportunity. We think there's income actually in the fixed income market. So we want to take advantage of that too.
Matt, it was great to have you on the show today. Thanks so much for joining us.
Thank you.
And still to come, while AI seems to be fast forwarding us to the future, how will the U.S. power grid be able to keep up with demand? I'm going to get the answer on the other side of the break. Stay tuned. More Yahoo Finance coming up.
Charter Communications is reportedly exploring a takeover of Altice USA. That's according to Bloomberg. It's unclear whether an offer has actually been made, and Charter could decide not to pursue a transaction. According to this report here, Altice, remember, was part of the European telecom company and then spun out of it in 2018. It has about 5 million residential and business customers over 21 states. So we'll see if something has been happening here. I mean, it's been a tough business for a lot of the cable providers.
Yeah, Bloomberg saying in this report, it's actually unclear whether a formal approach has actually been made as yet. And you know, obviously Charter could decide not to pursue something. It doesn't sound like the companies are talking either way right now. They do certainly have some things in common. Both are dealing with, you know, obviously wireless competition. Both also saddled with really plunging share prices. Your Charter's down about 20% over the past year. Altice is down about 50%. But you know, Patrick Jahi has made it clear, you know, Altice is up for sale and bidders are welcome. So we'll see how it was.
By the way, in addition to that big drop in the share price, Altice USA also has about $25 billion in debt.
Yeah.
So that's something that Charter obviously would have to consider.
Sure, for sure.
All right. let's talk about something else going on in media. The proxy battle continuing between Disney and activist investors. The latest round in the fight, Blackwell's Capital urging the entertainment giant to create the role of Chief Technology Officer. Yahoo Finance's Alexander Canal is here with the details. CTO, I guess I didn't realize Disney didn't, I thought everybody had a CTO at this point.
Yeah,
and
this is the latest development in this proxy battle with Disney. Blackwell's along with Nelson Peltz, two activists that are going for more board seats at the company. And now Blackwell's is laying out some of the changes, or more changes, I should say, that it wants to see at the company. And it says from a technological standpoint, Disney is lacking in 5 areas, including fragmentation, unhurried innovation, missing native technology stack, spatial computing, and AI mediocrity.
Ooh.
Yes, Blackwell's saying, quote, Disney must produce an artificial intelligence strategy and share elements of that strategy with its shareholders. Blackwell's also suggested that Chief Technology Officer to focus on technology transformation. I do want to say that Disney has been researching new technologies. They did establish that AI task force last year to really study how artificial intelligence could be implemented across the company, which is something that Blackwell's did not acknowledge. So it just sounds like this activist doesn't think Disney is doing enough in comparison to the other tech companies out there to really utilize AI. This is also a hedge fund and activist that has made other suggestions, saying that Disney should potentially break up, saying that its hotel and parks business should be potentially spun out into a separate real estate investment trust. And these are all things that Disney has really pushed back on, saying this shows how Blackwell's just doesn't understand our business, because we thrive off of the synergy between all of the different components of our business. So Disney, for its part, has been in constant communication with its shareholders and really urging them to stick with the current board, that any of these other board nominees from these activists, it's going to throw off the progress overall. But we'll see. The shareholder meeting is April 3rd, so we don't have to wait too much longer to figure out how this all ends.
That's a lot of drama. Thank you, Allie, so much. Appreciate it. Moving on, AI enthusiasm powering an impressive market rally over the past few months, but the U.S. power grid may not be able to keep up with that demand. One study finding that training a single large language model program takes the same amount of electricity needed to power 120 homes for an entire year. Experts are concerned existing electrical supply may fall short of AI's needs. And joining us now is Timothy Fox, Clearview Energy Partners Managing Director. Tim, it is good to see you. So I guess I'll start there. If that is sort of the challenge here, Tim, or potential challenge, how is our grid here up to the task, Tim?
Well, thank you for having me. I mean, this is coming at one of the most pressing times for the grid. I mean, one of the most prevalent issues facing the grid today, the power sector, is trying to ensure grid reliability at the same time it transitions to cleaner but also intermittent resources. As a shorthand, we call this going green without going dark. Now, for data centers that could facilitate AI, reliability is imperative, and therefore it's imperative to us. Data centers not only facilitate AI, but they're the backbone for our industries, for our commerce, for our transportation, for our health. These are mission critical infrastructure. So it's going to be important that while we're facilitating this new industry, it's not lights out for the existing industries.
Well, and how do you make that happen, Tim? I mean, what kind of increased demand are we talking about when it comes to the U.S. grid? I mean, do you have any estimates as to, if we continue to see AI grow at the same pace, then, power companies are going to need to provide X amount more energy, and where is that energy coming from?
Sure. So we don't do studies, but we've seen plenty of studies. And on a national U.S. basis, power for data centers could reach about 35 gigawatts by the end of this decade. That's up from about 17 gigawatts at the end of 2022. Now, to put that in perspective for those who may not be following the power sector as closely as I do, that's about as much power as the state of New York consumes at any moment on the hottest day in the summer. It's their peak demand. So you're saying that these data centers would be consuming about as much power as the state as New York does during the hottest of days in July or August.
And Tim, would you expect to see some kind of policy changes due to some of the issues you're highlighting here?
Well, you certainly could see some. Policy changes tend to come during instances of grid instability or energy scarcity. As long as the grid is working, it may keep lawmakers at bay. The bigger concern, I think, for a lot, it comes from a lot from state regulators, state legislators that create the policy are also often have an agenda. The state regulators seem to be far more concerned about ensuring grid reliability than some of the state lawmakers.
And, will we see some kind of crisis here? Can the grid produce that much more energy?
Well, we're not in the game of projecting, but I will say there are a couple risks here that could come up. So first of all, a lot of the U.S. faces long interconnection queues. Just getting a project from an idea to on the ground and developed takes a long time. It can take multiple years. In fact, some of the wholesale regional markets that facilitate interconnection have paused interconnection queues in order to address the backlog of projects that they've been looking over for years. Now they're trying to, both the markets and the Federal Energy Regulatory Commission are trying to reform those interconnection processes to make them more efficient, but that's still a work in progress. So that's the first issue. The second issue are supply chain constraints. It's getting the equipment they need to deploy projects is getting harder to do. And the final issue is interest rates. The power sector is a capital intensive industry. So when the interest rates go up, getting the money to pay for these large investments becomes a challenge.
Tim, I'm interested too, just more broadly, as you look across the country, as somebody who really studies this backwards and forwards, are there certain states, Tim, that you believe are in a relatively strong position with their grids, as opposed to others which you would classify maybe as being more at risk, more vulnerable?
I would say that for the states that are perhaps at greatest risk, because they tend to attract data centers, are Virginia, California, Texas, Arizona. These tend to be the places where where the IT professionals like to deploy data centers. But these utilities that serve those areas, they know that this is coming, and so I think they're working proactively with potential customers, with their regulators, trying to anticipate and prepare for this upcoming demand.
And then are there also implications for electricity rates? Now, I know it's a highly regulated industry, but if you are seeing more demand, in theory, at least you could get some renegotiation of rates, or do you not see that as a concern?
Well, Economics 101 suggests that if demand goes up, so does, the price. Yeah. But you're right that this is a regulated industry. Now, it depends on where the data centers are deployed. If they are in wholesale market areas, that and as a consequence of their demand, supply becomes constrained, that there could be concerns about wholesale market prices going way up. We saw that for non-data center reasons. For example, storm-related, weather-related issues in Texas and in California, where prices skyrocketed because demand outpushed supply. So here, what they're going to be looking for is to find power prices that can work for the data centers and for the customers.
Tim, thank you so much. Really appreciate it. And obviously, this is a situation and an issue that's not going away. We appreciate your time.
No, absolutely. Thank you for having me.
Thanks. Coming up, shares of Li Auto are higher today after the Chinese EV company did beat fourth quarter earnings expectations. We'll be joined by a strategist to help tell you how to play the Chinese auto sector on the other side. Chinese automaker BYD debuting its new electric supercar with a price tag of $233,000. The U9 is expected to rival brands like Ferrari, and according to the company, will be able to reach speeds of 190 miles an hour and drive on only 3 wheels. Perhaps Superman is here with more. I don't know why you would want to only drive on 3 wheels, but
because you can, Julie.
But how does physics work? Whatever. We'll leave that one aside for a minute.
I gotta look into that 3-wheel thing. But yes, the U9 debuted today in Geneva, the Geneva Auto Show. We saw this car earlier, but this is the actual production or the launch model of the car. Only going to be sold in China here, limited quantities. You mentioned $233,000. The difference here is that this car is a pure EV, right? So Ferrari and McLarens, they are gas-powered, in some cases hybrid-powered, so not fully EVs. I think this is a really compelling model for the money. You see the top speed there, 192 miles per hour. Very, very competitive specs there. Pretty impressive. I mean, I'm curious how this would sell in America if it came here, but we're not going to see Chinese cars here anytime soon. So,
can I quick follow-up for you? What does one do with a car like this? Where do you drive? Like, do you just go to a track and drive at 192 miles an hour? Is that what people do with these?
You could, if you were a serious sort of enthusiast, sports car enthusiast, and a track driver, yeah, you would take that to the track. But for most people, it's just, parking outsid, meatpacking.
And being able to say it could go 192 miles per hour.
Yeah. And I have this cool-looking car.
Okay, got it.
Praz, I mean, one thing that's strange to me is the comparisons people are making, like it's some type of competitor to Ferrari, which I don't see that. Do you think that's fair? I really don't see that as a comparison.
I think we're talking about two different.
Totally.
People who want to buy Ferrari are not going to buy this the Yangwang U9, right? In China, maybe there's a little bit of a different story there, but the Chinese market has been very sort of forward on how much they love the brand names. They love Western luxury brands, Bentley, Porsche, Ferrari. These are Rolls-Royce. These are top markets for those brands in China. So I don't see them going away anytime soon.
Of course, Ferrari wasn't always Ferrari, so I guess you got to start somewhere.
That's true.
In other auto news, Ford is having to delay certain of its shipments.
Yeah, so basically with the F-150, the very popular 2024 F-150 models here. So the Lightning right now, there was reports of a stop sale because of a quality issue. Ford got back to us, said that they are ramping up those deliveries, but they're still sort of holding back. They didn't deny the stop sale, right? So something's going on there with the quality issue. The gas-powered truck also delayed. Automotive News talking about hundreds, if not thousands of vehicles are stuck in lots in Detroit for who knows what reason. They say a quality control issue as well. Now Ford says they're delivering some of the lower trim XL and STX trim models out to customers now, but the higher trim levels haven't gone out. Again, Automotive News are talking about how a commercial customer had almost 100 trucks on order. Those have been delayed, and they have not heard back on when they are going to see them. So this is a problem for Ford in terms of this is their cash cow, F-150, the gas-powered truck. It's a big deal for them as we talk about Q1 being impacted here with the new model.
Yeah, it's a bread and butter. Praz, thank you so much. Appreciate it. Moving on, shares of Li Auto are surging after delivering a better than expected earnings report. The strong results given other Chinese automakers, NIO and XPeng, a lift too. For more, we're talking to Crane Share Senior Investment Strategist Anthony Sassine. Anthony, it is good to see you. So let's start there. Li Auto reports. Investors clearly like what they heard, Anthony, but you've had time to look over the report. What did you make of those results?
Yeah, it's definitely better than expected. Li has been one of the leaders in that space for the past couple of years, really making a big mark in the Chinese EV market. They were one of the very few companies that were able to become profitable within a 3-year period without even any backing from major companies like XPeng is backed by Alibaba and NIO is backed by Tencent. Really, Li Auto doesn't have a major backing. So the company continues to deliver. And, it's kind of a little bit of a reminder, too, that the slump we're seeing in EV, it's not as bad as people think. But definitely there are a few companies that are doing better than others. And that's one of them is Li Auto. The other one, potentially, we're going to expect a good performance from is BYD. And Tesla's right around the corner as well.
I mean, if you look, Anthony, it's Julie here. If you look at the Chinese EV makers and their U.S. shares year to date, I think Li's the only one that's actually higher on the year. And of course, Tesla hasn't been doing so hot either. So as you look into this year amidst the price war that has been ongoing in China among these companies, is Li the one that you would be a buyer of, or do you think that there's potential for these other stocks to do well also?
Yeah, look, Julie, over long term, I think EVs are going to be fine, right? Because we're trying to replace 1.3 billion ICE cars with EVs. We're still at 45 billion this year. So there's still a long way to go. But in down cycles like this year, where we're going through kind of a transitional period between two growth waves, the high quality cars are gonna fly. They're gonna float to the top, right? And we're seeing that with Li Auto. Li Auto was only $28 or $26 like 2 weeks ago. Right now, after that bump, you're seeing it at 40. You're seeing it do well this year. So basically, the negative sentiments took down most EV cars, quality and non-quality this year. And I think we're really overshot to the downside. And Li Auto is here to kind of remind us. But Li is definitely one of the top choices. BYD and Tesla's as well. NIO Xpeng. They have something to prove still yet, because their sales are not really passing the 15,000, 20,000 a month. They still have some work to do. Plus, these are more expensive cars. So in a year like this, you would expect consumers not to buy as much the more expensive cars. But the EV sector in general for the long term, as I mentioned, is going to be good. The way we advise investors to invest it through ETFs, through cars ETFs, crane shares, because it has all the different companies. Taking bets on separate companies can be risky. Why not get exposure to the whole pie over a long term?
And Anthony, we were just talking to our colleague too about that new BYD supercar. Anthony, interested to get your take on that. Some are comparing it as if the kind of rival, the comparison here would be Ferrari. I'm not sure I really see that, Anthony, but maybe I'm wrong.
Yeah, no, I like the three wheels drive option thing. I think that makes a lot of difference, and I don't think Ferrari can say that. But look, Chinese companies are coming in every different sector and every different industry, right? A few years ago, we didn't trust solar companies in China. Now they are the best. Last year Tesla was the leading. Today it's BYD. So Chinese companies are really moving into that upper value chain, and they're really starting to compete with brands like Ferrari and Lamborghini, and I'm not surprised. Are we there yet with regards to that? I don't know. That still has to be seen. Definitely the price point is going to be at a level where it kind of compensates for that difference in brand. But they're moving up there with great technology and great manufacturing ability that allows them to do this for less. And in the next few 2, 3, 4 years, you're going to see these companies stand up. They're on the way.
Do you think that the U.S. market is going to have to open to them in order for them to really see that next leg of success?
Yeah, that's a little bit tough to see, especially like today I saw an article talking about like an extermination event if the Chinese cars are able to to come into the U.S. market for the U.S. auto companies. That's bad. That's bad politics. I don't think it's going to happen anytime soon. But look, the real story here, especially for the electric vehicles, is in China, right? China is the biggest EV market by far. You're talking about 8-9 million sales a year versus 2 in the U.S., even in Europe. Europe is at 3. I think China can survive on its own domestic consumption for a little while, and then Europe is not too close to them. There's a little bit of friction there, but I think they may be able to get over it by setting up factories in Europe. The U.S. is a totally different story because the Biden administration Inflation Reduction Act is trying to close these loops where Chinese companies will be able to participate. We'll see how long that lasts, because that means EV products are going to be more expensive in the U.S. than the rest of the world if you don't allow Chinese companies to participate. But for the short to medium term, I think Chinese companies will be fine just focusing on domestic market.
Anthony, thanks so much for joining us today. Really helpful insight as always. We appreciate it.
Thank you. Appreciate it.
And coming up, closing bell on Wall Street, we're checking in on the latest market moves and the top trending tickers. Stay tuned.
got the closing bell on Wall Street, so let's do a check of the market, see where everything ended up here. And I guess it didn't end up at all. It ended down, in fact, for all three major averages. The Nasdaq had been eking out a gain an hour ago when we checked in, but finishing the day lower by 1/10%. The S&P 500 off by 1/4%. The Dow off by 62 points, just over 1/10% as well. So again, sort of a pause of the upward momentum that we saw for a lot of stocks last week. We talked earlier about Alphabet and the role that played with the decline in communication services stocks today. So that part of the reason the Nasdaq was lower as well, Josh.
Stocks ending the day a little change here as investors wait on some key economic data this week. Jared Blickery is here with a look at today's action. Jared.
That's right. Only the small caps managed to end in the green today. And when we take a look at the sector action, it was all about energy. That was still in the lead as of the close there, followed by consumer discretionary and tech. So a little mega cap action in there. But for the most part, seeing a lot of red. Utilities down 2%, communication services down 1.5%. And we can see some of these losses here. I said communication services, second worst sector of the day. Alphabet, the worst performing big cap stock in there, down 4.44%. More disappointment over Gemini. We'll see how that shakes out. But look at this, Nvidia, the sole mega cap. Well, can we still put Tesla in there? We're going to call Tesla a mega cap. That's up 4%. Nvidia up 1/3%. That is a 23rd record closing high this year. So it is number one in that respect. It bests Boston Scientific, which only has 22 and did not notch one today. And I mentioned these mega caps here at Tesla, almost about to be overtaken by Broadcom. Let's take a look at that race. $635 billion for Tesla, Broadcom $612 billion. It was only a couple months ago that Eli Lilly finally surged ahead of Tesla for the first time. So we'll have to see if there's another race in there. And here are our leaders for today. Not surprisingly, Bitcoin, the number one gainer, up over 6%. That has just been exploding to the upside. Is it up to 55,000 now? Have to check in a minute. Then we have disruption. ARK has been doing well today. So that is a flip from last week when unprofitable tech was not doing well. Some returns today and also IPO. So we're seeing some fringier parts of the market along with silicon, semiconductors, software, and biotech. And by the way, small caps. I did mention small caps ended in the green. What did not work today? We have cannabis, Korean stocks, regional banks, low volatility, and looks like also Chinese shares. Let's take a look at Chinese stocks here today. Li Auto, outsized day, up 19%, but not a whole lot of bullish action outside of that. We'll throw NIO in that bucket. That's up almost 5%, and Xpeng as well. So a good day for Chinese EVs. But in the number one performing sector in the U.S. today, at least on a large cap basis, not even seeing a lot of green here. So I did promise crypto. Let's take a look at that price there. 54,430, guys.
Jared, thank you for the recap. Appreciate it. Berkshire Hathaway shares pulling back after hitting a record high early in the session. The company reporting a big profit gain in the fourth quarter. The highs of the day, that company was closing in on a $1 trillion market cap. And joining us now is CFRA Vice President of Equity Research, Kathy Seifert. Kathy, it is good to see you. Just looking at these results, so Berkshire's reporting posts a record, Kathy, $37.4 billion in operating profit. Interested to get your take, Kathy, on the report. What'd you make of it?
I thought the numbers were decent. I mean, this is a large company, and for all of 2023, they posted almost a 20% operating revenue growth. Berkshire has a really good insurance franchise in Geico and a reinsurance franchise, and as well as a commercial lines franchise. And that really drove results. That plus higher investment income. I mean, there are some drags on results. And I think one of the reasons why the stock may be a little weak today is some concerns over Berkshire's utilities exposure and some of the wildfire liability that their utilities subsidiaries have. But all in all, I thought it was a really good quarter and a year.
Kathy, it's Julie here. What do you make of Warren Buffett's sort of tempering expectations, which I guess is not that unusual for him to do, right? But, to say that for a firm of their size to continue to grow at this rate and also to continue to find opportunities is just going to be difficult. Is that something that you think should dissuade investors?
No, I mean, I think the letter addressed a number of things that had been speculated, whether or not Berkshire was going to buy Occidental Petroleum. He addressed that and said definitively they were not. The Japanese trading companies that they took an equity stake in, there was a question about whether or not they were going to acquire those. And I also think that Berkshire is trying to tamp down expectations because they are so large. It's really difficult to move the needle when you're this big, which isn't to say that they're not going to deploy some of their $160+ billion in cash into acquisitions. I just think he's trying to tamp down expectations that he's going to make some blockbuster deal.
Are you surprised, though, Kathy, that he is sitting on that kind of mountain of cash at this point? I mean, $167 billion. Do you think it's the right move? They haven't done a big deal, Kathy, correct me if I'm wrong, in some time. I'm wondering if you're surprised they haven't put that to work.
Well, as an insurance company, they do have to keep, a fair amount of powder dry to pay claims. So it's not as though that entire, cash trove is available for him to deploy into acquisitions. I actually think the deal that they made a couple years ago to buy Allegheny strategically was a great move. It increased their presence in one of the few businesses where there's pricing power and there's secular growth, and that's the commercial insurance space. It also got them Joe Brandon back into the fold, which is an important consideration because I do think succession is going to be an issue. But back to your question about cash, I think that they will gradually, make some deals. Again, market valuations are not that attractive, which, to my mind, makes me think they may look at private companies, but they also have a lot of competition from private equity, venture capital. So I do think that there is a level of frustration at Berkshire, about deploying that capital. There's also the option to buy back shares. The shares have been on a tear this year so that, even their own shares may not be as attractive to them on a buyback perspective.
Do you think that frustration is shared by shareholders as well? Or do you think that most of the folks who hold Berkshire are sort of content to just ride it out and be patient?
I think Berkshire has a fairly satisfied investor base. I do sort of wonder in a post-Buffett environment if there is a push to initiate a dividend. They're one of the few sort of non-tech, they're not a rapidly growing firm. They're a value stock, yet they don't pay a dividend. I could see a situation where, sometime in the future, perhaps their investor base pushes them to initiate a dividend. But my sense is that the majority of Berkshire Hathaway's shareholder base is a pretty satisfied bunch.
And Kathy, I'll get you out of here on this. Kind of looking ahead, it was interesting. Buffett said, listen, he thinks his successor is ready to take the baton. Said Greg Abel, ready to be CEO tomorrow, I think is how Buffett put it. Is that how you see it, Kathy?
Yeah, I mean, I think as we head into the annual meeting, I think front and center in investors' minds is the succession issue. I mean, Buffett is 93. I do think that they could do a better job of highlighting the strength of the management bench a couple of levels below the C-suite, because there is a pretty strong team there guiding a number of the different operating subsidiaries. Yet shareholders rarely get the opportunity to really hear from these people. I think in the letter, he made a very interesting point when he said, join us in Omaha, and Ajit and Greg and I will be on the dais answering your questions. So I do think there's a concerted effort, as well there should be, to sort of, calm investor concerns about the succession issue at the company.
Kathy, thank you so much. Really appreciate it.
My pleasure.
Shares of Workday are on the move after that company just came out with its numbers. The workplace management software company saying fourth quarter sales coming in line with estimates. It beat on the bottom line. The outlook for subscription revenue left it room to miss the street's expectations. And Workday also announcing its intention to buy HiredScore, which is a company that uses AI to provide talent Solutions. Right now, the shares are moving down by about 5.5%, but they've sort of been bouncing around a little bit here. That subscription revenue forecast I mentioned, the company's forecasting subscription revenue for the full year of $7.73 billion to $7.78 billion. $7.77 billion is what analysts have projected. In other words, if you look at the midpoint of that, it's below what analysts were anticipating, even as its revenue met last quarter and earnings beat estimates. But the subscription revenue seems to be a source of disappointment, Josh.
Yeah, no, this stock also, it had been such a rocket ship, Julie. It was up, I think around 10% already this year. It was up around 70% over the past 12 months heading into the print. Their bread and butter is still HCM, which is their cloud-based HR suite. They're also focused on kind of financial management applications. So it'll be interesting, kind of the puts and takes there. What they say on the call. You're right. The big number for them is always subscription revenue because that's the money they earn from the software they're selling. So it'll be interesting on the call how they explain some of what they're seeing looking ahead. It could be, there's so much uncertainty still around the macro. Julie, I wonder how perhaps when they're forecasting guiding too, they're just trying to be a bit more prudent here as well. But we'll see on the call.
Well, and it seems as though this is a reiteration of that forecast. So if there's disappointment, it's that they did not raise it, I suppose.
When the stock's up that much, expectations running hot for that print for sure.
For sure.
Coming up, we're rolling in on with the earnings as Zoom, by the way, is the latest to report. The shares are soaring right now. Look at that. Those numbers on the other side of the break.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Well, check out shares of Zoom. They are flying higher here after reporting a beat on both bottom and top and announcing a share buyback. Let's quickly break down the numbers for you. So Zoom, Julie, adjusted EPS 142 versus 115 consensus. Revenue 1.15 billion. Expectation was 1.13 billion. So beats there on bottom and top lines. Looking ahead, Q1 revenue, they see 1.13 billion. That's in line. For 2025, they're looking for 4.6 billion. The estimate was around 4.66 billion. And importantly, though, the capital return news here as well. They did okay a stock repurchase program of up to 1.5 billion.
Yeah, and it's interesting. They hit all the popular notes in the press release. Eric Yuan, the CEO, among other things, talking about democratizing AI accessibility in the release here. But one of the things that people have been looking for consistently from the company is large customers, but also adding on sort of diversity across the size of customers. The company said it has about 220,400 enterprise customers, which is up 3.5%. If you look at its largest customers, just over 3,800 contributed more than $100,000 in trailing 12-month revenue. That's up about 9.8%. So those are numbers that investors are going to be looking for as well.
Yeah, I mean, Zoom, we always think about it, was such a pandemic darling and enjoyed such strong growth. Post-pandemic, not as much enthusiasm for this one. I mean, heading into the print, this one was in the red year to date and over the past 12 months. And you would hear analysts who covered it saying, you know, yes, it was cheap, but they were kind of waiting for a catalyst, right? Maybe now they've got it.
Well, and there's also competition from the likes of Teams and other
big
video
competition
call
from Microsoft for
services.
Sure.
So that's something that investors have watched closely as well. Well, Bitcoin reaching its highest level in more than 2 years after breaking above 54,000 in today's trade. But it's not the top cryptocurrency of 2024. Year to date, that title goes to Ethereum. Ether has managed to outperform its larger crypto rival. With more, we're joined by Ryan Rasmussen, a Bitwise senior crypto research analyst. Hey, thanks for being here. So I guess let's start with Ethereum here. Bitcoin caught a bid when spot Bitcoin ETFs were approved. Is anticipation of the spot Ether ETFs being approved, is that what's going on here?
I certainly think that's a bit of what's going on here. I mean, we saw Bitcoin ETFs become a buy the rumor and buy the event situation. And so I'm not surprised that we're seeing Ethereum catch a similar bid here heading into the potential approval of spot Ethereum ETFs in May. So yeah, that's definitely driving some interest from institutional investors. We're seeing a lot of interest in the options and futures market for Ether ahead of that potential approval date. So I certainly think that's contributing to the outperformance from Ethereum relative to Bitcoin this year and recently.
I'm interested, Ryan, because let's be honest. I mean, Gensler didn't want a spot Bitcoin ETF. He was dragged into it. Unless you disagree. So I'm interested, to get a spot Ethereum ETF. Do you think you'd actually need to see another lawsuit?
Yeah, no, I agree with you. I think it's a great point. We didn't see spot Bitcoin ETFs get approved on the first go around. Certainly, there were many attempts at bringing spot Bitcoin ETFs to market before we ultimately got an approval. And that was on the back of a grayscale lawsuit that ultimately benefited ETF issuers and drove to that approval. I don't know the same will need to happen for Ethereum ETFs. I certainly don't know if the market is necessarily in a point the SEC would like to see in order to approve the spot ETFs this May. I would think it's about a 50% chance that we'll see approval or we'll see rejection and kick it out to another kind of round of applications in the future. I don't know if a lawsuit is necessary. We're definitely not at the point where any of the issuers could file a lawsuit today. And so perhaps on the tail of a rejection, we could see that happening. We did see Ethereum futures ETFs get approved last year, and that certainly was the case for Bitcoin, where those preceded the spot Bitcoin ETF issuance. So, it's up in the air, but I think that we have about a 50-50 chance of approval or denial coming up in May.
And what is, obviously Ethereum is not the only thing rallying. So we've got also sort of a broader rally in crypto. Bitcoin, we mentioned as well, above 54,000. There's a lot of talk about the halving maybe playing a role here. And it's always a little bit tricky to figure out exactly what's going on, but what's your best guess?
Yeah, it's certainly tricky. There's a lot of forces at work here in the crypto market. So I think for the case of Bitcoin, we're seeing two things at play. There's a lot of excitement around the halving. We're certainly seeing futures traders kind of take those positions going into April around where they think the price is going to move, and following the halving, we think they're positioned bullishly, and that's what the data would show us. For Ethereum, it's speculation on Ethereum spot ETFs. There's a lot of excitement around a new upgrade coming to the Ethereum protocol, the Ethereum network in March. It's called Dencun. It's kind of a funky name, but that should lower the cost to transact on Ethereum and Ethereum L2s. So that's a really exciting development that should bring new use cases and new adoption and activity onto the Ethereum market. Then you have platforms like Solana, which have really outperformed other crypto assets back in 2023 and have had a strong 2024. We're seeing a resurgence in NFT trading volume and NFT prices. So I think ultimately what we're seeing is crypto is kind of rising from the ashes of the 2022 market. In 2023 was the start to that rally, but we think that we're in a multi-year bull cycle, and all elements of the crypto space will certainly have their moment. Bitcoin in the spotlight right now, Ethereum making its way up there, and I think other L1s and other L2s and other DeFi assets and NFTs will have their moment in the sun as well.
And Ryan, I'm interested just longer term, how you think these new vehicles, these new products, these new spot Bitcoin ETFs, what are they going to mean for the underlying asset, Ryan? How are they going to impact pricing for Bitcoin in the months, years ahead, do you think?
Oh, yeah. I mean, we love these ETFs. Of course, us at Bitwise, we did launch a spot Bitcoin ETF in January alongside the other ETF issuers. And we've been tremendously happy with the success of those products. We've seen over $1 billion in assets flow into our spot Bitcoin ETF across the board. There's been more than 15 billion of assets flowing into spot Bitcoin ETFs. And what does that mean for price and the market? That's all buying pressure on the underlying spot asset. And when we have that kind of demand shock coming into the market, I think it's no surprise we've seen the price of Bitcoin rise following the launch of those ETFs. And I think it would be the same for Ethereum or other assets if there were ETFs to come to market. You have the demand coming from those sideline investors, of course, those institutional investors, financial advisors, RIAs, hedge fund managers who really wait for that regulatory stamp of approval and that institutional vehicle to be brought to market before they seriously consider allocating to the space. And with all that sideline capital, I think we're still in the early innings of crypto reaching its kind of point in the adoption curve where we have everyday investors, institutional investors, and retail investors all allocating to these products. And ETFs are just one of those really great vehicles that help bring those investors to market and help create a highway for them to allocate to not just Bitcoin, but Ethereum, Solana, and other assets as they eventually make their way into the ETF format.
Ryan, are you somebody who sets targets? Do you have some price projections for year end?
Yeah, price targets are always fun. I'll go ahead and throw one out there. We did release a prediction in December, actually, before we got into the new year, where we thought Bitcoin would hit in 2024, and we still stand by that prediction. We think that Bitcoin will certainly set all-time highs in 2024. That previous price is right around 69,000, but we don't think it's going to stop there. We think that we'll at least see a 10 to 15% bump over the last all-time high in 2024. That would take us to the mid 80K range. So I think our target was 88,000 by the end of 2024, and I'm still sticking by that, seeing all the excitement in the market today.
All right, we'll hold you to it. Well, at least we'll have you back on to talk about it. Ryan, thank you so much. Appreciate it.
Thank you. Looking forward to it. Thank you.
Still to come, the Supreme Court is hearing arguments in two cases that could shape the future of social media. We'll have the details when Yahoo Finance returns.
Microsoft has announced a new multi-year partnership with a French AI startup. Yahoo Finance's very own Dan Howley joins us now with more. Dan.
That's right, Josh. Microsoft is making a small investment. They won't say how much in France's Mistral. This is essentially a competitor to OpenAI. This is a move that allows Microsoft to have multiple models in its kind of arsenal of AI capabilities that it can offer to its customers. It also is a way for them to kind of get a little scrutiny off their back for when it comes to its close ties to OpenAI. You know, when there was the tumultuous kind of CEO swap that was going on with OpenAI, Microsoft was right there with them. They've invested billions of dollars into the company, and they kind of get closer and closer as the days go by. And so some regulators are questioning that. And so Microsoft investing in Mistral may allow it to kind of push some of those concerns off for now, at least in Europe. And so it's an interesting development. Again, the company hasn't said how much they are investing, but to be fair, the majority, any move where a company is able to add more models is beneficial to its customers overall. You look at Amazon, they do the same thing. Google does the same thing. So it should also help Microsoft as far as getting to its customers as well, not just getting the feds off its back.
Interesting stuff. Let's also talk about a potential brand new wearable from Samsung. It's the Galaxy Ring, which I guess sort of is a competitor to the Aura Ring. What do we know about it?
Yeah, this is kind of a new space for tech companies, these kind of smart rings. And as you said, Aura is kind of the chief company out there with one at the moment. Samsung will be rolling out their Galaxy Ring in the future. They were showing it off as part of the Mobile World Congress event in Barcelona. This is basically a health tracking gadget that, it acts as a ring. It can track you for multiple days. They haven't said exactly how long it will last, but the benefit of something like this is it's not as bulky or as attention grabbing as a watch. But it does provide you with the ability to track your health, your sleep habits, your heart rate, things along those lines. And it's on you for the whole day. I mean, it doesn't have to be charged too often. The Aura Ring can go several days without a charge, can track all of this kind of information. So this seems to be a way that more companies are going to be going. And apparently, according to Mark Gurman at Bloomberg, Apple is investigating whether it wants to invest in a ring of its own. So it'll be interesting to see how the market responds to these. I actually saw an Aura Ring in the wild on the subway a few days ago. First time I saw one, but still, it proves that people are out there buying them.
That's an interesting. You mentioned Gurman the idea here, Dan, that maybe Apple could get into it as well. Now, Apple doesn't sort of, hint at its product pipeline. Maybe some other tech companies do. But what do you say if you were to bet? You think that could be coming?
It could be, honestly. I mean, it feels as though it's something that they would explore. Apple explores all sorts of products and then, just says, nah, we're not going to do it. The Apple Watch is the best-selling smartwatch in the world. If they start to see maybe a divergence in the wearables kind of category where people are starting to pick up steam when it comes to purchasing these kinds of smart rings, then I would see Apple jumping in to the arena. But right now, it seems as though it's still a relatively niche market. And when it came to the Apple Watch itself, Fitbit already had a foothold in it. People had known about the technology, so it only made sense for them to get in on that action, and it's done very well for them. The Ring, it's still very hard to say whether or not Apple would do it. But like I said, they are looking into it according to this report, and it just doesn't necessarily mean they're going to put a product on the market.
All right, Dan, thank you very much. Appreciate it. It's interesting, these companies wanting to get into wearables, which hasn't been a huge, as Dan sort of alluded to, it's been sort of a niche market. It hasn't been a huge market. And you look at some of the wrist wearables, like a Whoop strap, for example, which, you know, I feel like there have been different trends in going up and down in these things being popular.
And the other tough part is you move into health, which you can understand why so many tech companies want to do, because that's an enormous market and an aging demographic, and it checks all the right boxes. But the way, as you move into health, you often can run into patent trouble. You know, you start designing. We've of course seen, you know, Apple has run into that exact issue, right, with Massimo. So the more you run into, the more you want health, it just seems to be a place where you can find legal trouble and regulatory trouble very quickly as well.
Right, so we'll see if that becomes an issue with any of that. All right, today the Supreme Court is hearing arguments that could shape the future of social media. At the center, 2 laws that seek to limit how social media companies moderate content on their sites. The state laws say companies cannot remove users or posts from platforms. Companies have argued it's their First Amendment right to do so. With more, we're joined by Sinan Aral, the David Austin Professor of Management, IT, Marketing, and Data Science at MIT. Sinan, it's good to see you. Thanks for joining us here. There have been so many attempts to try to figure out how to regulate this, so it's interesting, these cases and where they're coming from and the allegations that they are making. Is this the thing that ends up shaping content moderation for these companies?
Julie, great to see you. Thanks for having me. This is indeed an important case. It's important because the legislature can't seem to find unanimity in terms of both sides of the aisle coming together to regulate social media in one direction or another. And so here you see some states taking actions that support the more Republican conservative view that social media companies should not be able to moderate content that they deem as being censorship of conservative voices. These are laws in effect in Texas and in Florida. And then in other states, you have other kinds of laws that are pushing for more content moderation. And I think what is important about this case is that it has to thread the needle about, on one side, making sure that the social media companies have the ability to not turn the internet into a cesspool with no content moderation on one hand. But then on the other hand, not giving them a blanket immunity from any type of government regulation or legislation. We know that AI is happening right in front of us and right around the corner in terms of legislation. A blanket immunity would also not be good.
Sinan, I'm interested to get your take too, just for traders, investors who are listening right now. Sinan, what are the possible, as you think through them, business implications if the Florida and Texas laws were indeed upheld here?
Yeah, so that's a really important question. In my mind, there are 3 possible outcomes of this case. 2 of them are much more likely than the third, as far as I could see the questioning of the justices today. I think the justices are skeptical of these laws. I don't imagine that these 2 laws are going to be upheld in their entirety. I think that either they're going to be overturned or the cases are going to be remanded for further development in the lower courts. And the reason why that would happen is precisely the threading the needle that I discussed earlier, which is that the Supreme Court is likely to want to bound the impact of their decision. In other words, is this just about Facebook Blue and the news feed on Facebook Blue? Or is it also about Meta's WhatsApp? Is it also about other parts of the internet ecosystem like email? You saw them asking questions about exactly what are the boundaries of the scope of these laws and therefore their decisions about these laws. And at the end of the day, it's going to be about content moderation and how much of it is the purview of social media companies or not. It's a First Amendment case. Obviously, you also have the question of whether the government can pressure social media to censor certain types of content on their platforms. For instance, COVID misinformation. We know that we have a case in Missouri that is the Surgeon General against Missouri that is about whether or not the administration can pressure around COVID-19 misinformation content moderation policies. And so I believe either these cases are going to be overturned or it's going to be remanded for further development in the lower courts. And in that case, in either of those two cases, not much is going to change with the social media companies in the short term. To the extent that being remanded and coming back with a different scope creates meaningful substantive changes in content moderation, then it could have impacts on business policy. But for the moment, I think it's a wait and see for business policy.
Well, and there is a looming event here in the U.S. that this would be quite pertinent to, the presidential election, but it sounds like you think nothing's going to be resolved before that.
I think it's not going to be resolved in June or July, to the extent that there's going to be a quick development in the lower courts and a comeback, maybe. To the extent that the laws are overturned, then it's status quo, meaning the social media companies will continue to moderate content based on their editorial discretion and their choices. And that doesn't mean just banning users or banning posts. It means also demoting posts or reducing the amount that they spread on the platforms. That, by the way, is the status quo. So to the extent that that's what we have today, then I could imagine that remains in effect, or that it gets remanded and rescoped to understand, is this about email? Is this about private messaging? To what extent should different types of decisions be allowable or not allowable? These are really, really important questions, and I don't expect the Supreme Court to make a hasty decision. If there is a decision, I believe it will be to overturn these laws and maintain the status quo and try to maintain some consistency across state laws. But I think it's equally likely that the cases will be remanded to the lower courts for further development.
Big, complex questions and issues. Sinan, thanks as always for helping us walk through them. Appreciate it.
Thank you.
And coming up, we're going around the horn and checking in on some of today's top trending stories, including Adidas dropping a new batch of controversial Yeezy shoes. Stick around, more Yahoo Finance coming up.
Hello and welcome back to Yahoo Finance's group chat. I'm Josh Schaefer here with Alexandra Canal and Pras Subramanian. And today we're kicking things off with Adidas making the decision to sell its remaining inventory of Yeezy shoes. Those shoes were created by Ye, the music artist and fashion designer formerly known as Kanye West. Now this decision comes after the sports brand cut ties with Ye. That ended a decade-long partnership. This, of course, came after Ye made a series of anti-Semitic comments, a pretty public breakup for Kanye West or Ye and Adidas, and really the fallout has been what to do with this popular brand of shoes. Yeezys were very popular. They even had sweatshirts, clothing brand that went with the shoes. And Adidas had come out and originally said they weren't really sure what they were going to do with them. Then they offloaded some of the inventory. They sold some of the inventory to high demand on the website, I should mention. I remember we were tracking that over the summer at one point, and the shoes were really kind of flying off the shelves. And now it seems like Adidas coming back out and saying again, they're going to just sell more of these shoes because it seems like people want them, and also it's a way for Adidas to get rid of them. I mean, there was one point, guys, where they were debating basically almost lighting the shoes on fire or throwing them. They didn't know what to do with the shoes, and it seems like the solution has just been to sell them.
Yeah, it was almost a multi-billion-dollar write-down of that whole sort of deal, and then cut to now, and they can't sell them fast enough, right? The
Still
first
popular.
batch they sold, the second batch of a colorway that, by the way, Ye says that he did not approve this colorway. He's not making any money off this, but who knows what's going on? I'm not sure if they paid him out already or if there's some sort of back end there, but regardless of what he's saying, people are still buying these shoes, and I'm frankly a little surprised.
Yeah, I think it just points to the complicated relationship that can happen sometimes between consumers, brands, and creators. And I was thinking about just the type of consumer that would want this shoe. It's the sneakerheads. It's the people that are, really obsessed with shoes at the end of the day. And no matter what the circumstances, some of those people want to be involved or have a piece of sneaker history. I mean, Yeezys, you hear them, you know what they are, you know it's an Adidas shoe. It's something that I think gets people excited. It is interesting to see that the demand is still there despite it all. And Adidas has, since terminating that partnership with Ye, they have donated to organizations to combat discrimination and hate, including racism and anti-Semitism. But I'm sure that they're going to receive some backlash for this as well.
Oh, absolutely. And I think the collector's part of this you bring up is interesting too, right? When you think about how popular these shoes were in the collector space, to think that they're probably never going to be made again. And this is essentially your last chance to buy a fresh pair of Yeezys and probably never wear them, right? Because that's what, if you're really sneaker collecting, you're probably never going to actually wear them. You keep the tags on them, and there's probably some people thinking maybe these have value 10 or 15 years down the line because they were a popular shoe of the moment, and maybe as people sort of, I hate to say forget about that backlash as time goes on, but we know over time, people will start to not remember all of the backlash to some extent, and they will just be Yeezy shoes, and maybe they hold some sort of value there. Maybe that's part of why people are still interested in them.
Yeah, the news cycle definitely very quick, I think, there. But moving on from sneakers to sports, I've been looking at the future of Major League Soccer's deal with Apple TV. The league's latest season kicked off last week, and it got me thinking about the current fragmentation of sports rights. So basically, guys, unlike other sports like the NFL, where you need to sign up for multiple streamers, have a cable package just to watch the full season, you don't have to do that with the MLS. They consolidated all of their media rights a few years before they renegotiated their contract. They wanted one true partner, and they found that in Apple. It was also attractive to Apple as well because they didn't have to have competitors in the mix. They could have full control over the distribution of these games, and there's a lot of people out there that are thinking that this could have a big boon when you think about the Vision Pro headset and the opportunities there. I did have a chance to speak with Seth Bacon. He is the Executive Vice President of Media for the MLS, and he said that this is something that is working. They're seeing this partnership lead to an increase of viewership numbers, an increase of signups to Apple TV. But I don't know if you could see this with other types of players, like the NFL, for example. I feel like you're going to always have...
might be too big, right? And you're never going to get one sole partner when you think about the fact that one big tech company pays $1 billion for 15 games a year. Think about how much you would have to pay to have every NFL game. I think at some point it maybe is just inconceivable, just from that standpoint of like how much NFL rights are worth. But you're right, for MLS, it made a ton of sense. It's a league that wants to grow, a league that's looking for a consistent place for people to find them. I think sometimes when you're on some of these local sports networks, it's useful, but also sometimes people don't really know where to find those. Not everyone still has traditional cable. Right now, you could make the argument that, oh, they're on Apple Plus, that's hard, I have to pay for Apple Plus, etc. But at least you know where to get it. MLS is on Apple TV Plus.
Yeah.
There's one place to go, and I think that's helpful for consumers from that standpoint.
But it's $12.99 a month. It's yet another thing to add to your collection of streaming services, and you really got to be a big MLS fan if you want to do this. And I was a casual fan, and I feel like it's a bit too much money for a casual fan to get involved. I mean, I want to follow NYCFC and not so much the Red Bulls, et cetera. But that's sort of the equation you got to do here with this service. But I think you're right. I think it's a great service with the collect all of it in one spot. And you mentioned the Vision Pro. Maybe there's a good use case there for someone who has this, someone who's a fan. I don't know. It's maybe a more interactive or more just dynamic way to watch the content.
Yeah, and Apple's also producing a docuseries, sort of similar like we've seen with Formula One, Drive to Survive. So potentially that could add more fans. And I also think Lionel Messi coming to the MLS was huge for not only the league, but also for Apple and driving a lot of that
I'm excited to
viewership.
see what goes on the Vision Pro from a sports perspective.
I mean,
because if they can put
this is a
you in
10-year
the
deal.
moment, that's the kind of thing that you don't really get right now, and you would think that's where these headsets are going. So it'll be interesting to see what happens with that.
Yeah. From the beautiful game to the return of the rom-com, Anyone But You with Josh Schaefer favorite Sydney Sweeney and Ali Canal fave Glenn Powell.
That is
The
true.
movie with quite a bit of staying power, starting off modestly at the box office nearly 2 months ago, now topping $200 million. What does this say? It kind of got me thinking about, people want this not new, but they want old content that they're familiar with, rom-coms. Thinking about Wedding Crashers, right? That crossed 500 million, I believe, in the box office out of nowhere because it was the thing that people wanted. It was different, it was edgy, it was fun. I think that's what's missing in the box office is just sort of like fun rom-com. Let's just have a nice popcorn night.
Yeah, I
With
mean,
your faves.
with our
Well,
faves.
I was going to say Allie will have a much more nuanced opinion here because she covers media for us. My very unnuanced opinion is if you put Glenn Powell and Sydney Sweeney in a movie in 2024, it's probably going to do better than people expect because the population is obsessed with both of those with that actor and actress right now, and they created the nice little dynamic outside the theater where you're wondering if they're dating, and then they have all the kind of drama going on outside of it. I just feel like it was the right moment for that. So that's why, to me, at least that specific movie was.
Well, Josh, you bring up a really good point here because I think for original movies like this, like Anyone But You, to work, there needs to be a few things, right? Star power, which you mentioned, and a really fantastic marketing campaign, which they 100% did. But what's interesting to me, and this is an interesting stat, because out of the top 10 box office performers since 2016, I'm going to take out the pandemic year of 2020, less than 1% are true originals. It's really these sequels that drive the box office overall. So the fact that we're seeing a movie like Anyone But You have this staying power at the box office, it's continuing to gain momentum with that word of mouth that's widely surpassing expectations. I think speaks to what you're saying too, Josh, that the moment right now with these two actors, and also when it comes to just the desire on the part of the consumer to have something fresh and original. So I saw it, I loved it. I know you two are
I'm going to wait till the sequel comes out. If
all
the
about-
movie did well, there has to
Josh,
be a sequel.
It's all about that on-screen chemistry, right? It really is.
Yeah, I know you two want to watch it, for sure.
I got some homework to do. I got to go watch Anyone But You, I guess. But coming up, we're going to bring you what to watch tomorrow. We break down the stories you need to know to start your Tuesday.
Let's take a look at what's trending after hours. Some more companies out with earnings. Shares of Hims and Hers Health up in after hours trading about 16%. The company beating estimates across sales and earnings for its fourth quarter, swinging to a surprise profit and issuing a full year revenue forecast that topped expectations. Shares of the company are up more than 15% so far this year, gaining ground in recent days. And shares of Unity Software sinking after that company missed expectations in its fourth quarter, down 16%. The company saw a much wider loss than anticipated. Although revenue did beat expectations, the video game company's full year forecast was also well below estimates. In its earnings release, Unity outlining efforts to right-size its cost structure. It expects to reduce $250 million in operating expenses, a process it said should be completed by the end of the first quarter. And by the way, Unity also said it is evaluating its portfolio to see if it might want to offload some of its units.
And time now for what to watch Tuesday, February 27th, starting off on the earnings front. Earnings season we know is winding down here, but still some big names reporting tomorrow. Lowe's, Macy's, AutoZone, eBay, JM Smucker, and Massimo all set to post earnings. Lowe's reporting fourth quarter results before the opening bell. The stock having a solid start to the year. It's up about 4%.
Taking a look at the Fed, we're going to get some more commentary from one Federal Reserve official, Vice Chair for Supervision Michael Barr, speaking tomorrow, giving us more insight on if and when the Fed could cut rates. This coming after comments from New York Fed President John Williams on Friday, saying that the central bank is on track to cut interest rates, quote, later this year.
And moving over to the economy, the monthly consumer confidence report from the Conference Board is out tomorrow, measuring consumer attitudes regarding their finances. That number expected to tick up again, making it 4 straight months of gains and providing another economic indicator ahead of Thursday's big PCE report. Tomorrow, it's on your radar, Julie.
There are a handful of conferences tomorrow. On the financial services front, UBS is having a financial services conference where a bunch of companies are expected to present, including JP Morgan. So I'll be looking out, usually at those conferences, if the companies are going to come out with any kind of business update, they do it early in the morning before they present, so I'll be looking for anything on that front. And then KBW is having a fintech conference as well, payments conference, so I'll be looking for those companies. Here's just some of the companies presenting at that UBS one tomorrow.
All right, so watching for some headlines there.
Potentially.
How about Lowe's? Some earnings. Company reporting Q4 results tomorrow. Stock's up about 15% over the past year. On the street, opinions kind of fairly split on this one, Julie. 18 buys, 16 holds, 3 sells. Puts and takes in the quarter. Analysts do mention how home improvement spending has been kind of relatively soft. The company does face, they say, some difficult expense comps with this print. More generally, obviously, the macro been kind of choppy, but some analysts are telling clients they have seen signs of improvement from kind of trough levels, they say. So we'll see.
All right. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.